discussing Tesla earnings. So this is a post-earnings call analysis, also a preparation for our investor relations call that we have next week. And I think for people who are new to this podcast series, the purpose of this podcast series, not even a podcast series, is to give people a sense of what it feels like to run a hedge fund. Tesla is, I would say, by far our largest position, of course. Therefore, it is incredibly important to have a good grasp of the situation. And we're doing this. We did a pre-earnings call. Now we're doing a post-earnings call. And the idea is, of course, to have a sense for where we stand and what the situation is and understand what the stock has been doing. I think here are the big takeaways. This is a reset of the company. Growth reset, earnings reset, margin reset. What's not being reset is innovation, technological innovation, growth, long-term growth, long-term valuation. All of these things are still in place, but we have a 12 to 18 months hiatus now. This is the reset. We have to live with it. It's going to cost us in the stock. We believe that the stock will probably see the high hundreds, if not just stick around 200. It's not the bottom. Usually these post-earnings reactions, they last longer, so we could have a sell-off of maybe, let's say we go from 240 down 30%. That's like $70. So we're looking at maybe 170 as a downside. That's in the cards right now because it's a reset. So let's be clear. Let's not kid ourselves. We have to live with this situation right now. What has the company said? I don't want to go too deep in the prelude. This is what I want to discuss in this episode. But here's what I want to say in the prelude. I think it is concerning in a sense that the company is definitely feeling the pinch on the macro side. But what doesn't kill you makes you stronger. It has never been more true than in this particular situation because Tesla's going to come out the winner, not just in the EV space, but in the whole transportation industry. And this is going to catapult the valuation to the trillions that we expect. This is not even on podcast. It's October 20th, 2023. This is Cryptelco. Since the last update, we're down 27%. The market is, since the last update, we're down roughly 20%. The market is down 2%. For the year, we're up 80%. The market's up 12%. We're outperforming by 68%. So the earnings call through Q3 2023 is a resetting growth. The company is expecting less volume growth. The company is expecting trough margins and therefore, of course, an earnings and cash flow hit to the balance sheet and the cash flow statement and the income statement. Why? Well, we have a convolution of things, right? We have, on the one hand, we have the macro situation, which is going to make it more difficult for the company to grow volumes. We expect maybe 10% volume growth next year, so we're looking at maybe 2 million cars delivered. The company did not want to commit to any kind of delivery guidance, so that's the first, I would say, risk to the company. Second, we have margin trough because we have massively lower prices and the cost is now adjusting. So we believe that we're probably looking at margin trough in this quarter. And going forward, we'll have better margins. The only thing on the gross margin side, on the operating margin side, we still expect trough levels to come maybe in about 6 months because of Cybertruck. Cybertruck is they warned in several instances that Cybertruck is going to be difficult. It's going to cost money. Volume production is going to be difficult. All those sort of things. But that's okay. That's just the way product launches go, particularly when you launch a new product like Cybertruck, which is, according to Tesla, not just a new product, but it's a new concept. It's a new architecture. And so what do we expect for margins? Like the way we think about margins is we believe that going forward, we will have actually with less aggressive volume growth, we could have a consolidation of margins. We could have a little bit higher margins, less growth in terms of sales, but higher margins and therefore back to earnings growth. We expect roughly $3 for the full year next year, which is a growth from the run rate this quarter. So it would be a decline year over year, but from the run rate this quarter, it's 55 cents. This would be growth. And with $3 a share at roughly probably 60 to 70 PE, maybe it could go down to 50 to 60 PE. We're looking at maybe 170, 180. That should be a trough level for the stock. We're now at 210, so it's still about 15% downside. We then are looking at recovery of the stock, so we could go from $3 to $5 very quickly in earnings once Cybertruck kicks in, once the earnings and cash flows from there come with high margins. And of course, one of the biggest silver linings of the call, actually, the nugget that was buried in the bad news was energy storage. We had 24% gross margin. We contributed $400 million in gross margin. That's real money. That is, if you look at 40 gigawatt capacity in Lathrop, and now they're about 4 gigawatts, so this could be a 10x at 20, let's say 20% gross margin. We could see billions of gross margin contribution from this business in the next couple of years. Now, the CFO has warned that it will be lumpy, so we're not going to get a steady growth here. But nevertheless, this is definitely a big, big plus. And let's discuss the real discussion. Now, this is the discussion we want to have with the investor relations person, okay? There's really two things I want to discuss. I want to discuss this company as an AI company. So we have Dojo, we have a chip manufacturing, a chip design operation for training video data. What does that mean? What is the upside? What exactly is Tesla doing that the market is not doing? Why are we even in this business? I would like to understand better from the investor relations person, who, by the way, has been with NVIDIA. So the person I'm going to talk to, I forgot his name. He has been with NVIDIA, so he should know, like, what exactly, why is Tesla in the computer architecture business, and what is the upside here? How should we think about valuation of this? When is it going to materialize and how? So this is number one. Number two, of course, one of the answers is going to materialize through FSD. Now, on the FSD front, there's two big vectors. One is, of course, the monetization of FSD through Tesla, and the other is monetization of FSD through third parties. Is there anything in the talks? Are we expecting that? So this would be the second big point that I want to discuss. Now, our thoughts on this are that eventually Tesla will become a service provider for charging software and operating software for cars. The way the software-defined car is going is that somebody's going to have to pick up the slack here, because the OEMs, the car manufacturers, are not able to deliver a software-defined car. The only company which is able to do that right now at scale is Tesla. Therefore, Tesla is going to be the winner, and Tesla is going to be a software provider for cars if they choose to do so. This is the conversation we want to have with the IR. So again, the two big software questions are: one is how should we think about Dojo in particular, which is a computer architecture endeavor. I mean, this is something that companies like NVIDIA would be doing, or companies maybe like AMD. Why is Tesla doing it? Are they good at it? Can they hire the talent? What is the edge? What is if I go to AI conferences, robotics conferences, it's not very often that we talk to people about hardware, about things like, let's say, in-memory compute, or how to have low power, high density matrix multiplications that are important for in this case the models that Tesla is using. I also want to talk about end-to-end learning. Actually, I spoke with robotics people from Berkeley yesterday at the Baylor conference, and they told me that they don't think that Tesla is doing end-to-end learning. So this is a question I want to ask. Okay, what exactly is end-to-end learning? How is the transferability of end-to-end learning to other tasks? Are we in what realm do we live here? Is this hype? Is this real? Those are the kind of questions I would like to clarify with the investor relations person. The other tangent I want to touch upon is the energy business. What are the expectations, volumes? That's something we can do real numbers on, valuation. We can, have a better financial model based on that. I mean, I would like to have a financial model also for the AI side of things. Musk said several times we're the best real-time AI company. So what does that really mean for investors? Those are the kinds of questions we would like to discuss with the investor relations person. Now, to finish this episode, I want to finish with my analysis of the earnings call. And I would say the reset in growth is definitely a bummer, but it's expected. We can't expect the company to keep growing in the 20s or 30s, which that's what they're doing this year, because they can't lower price. They're not going to be able to lower prices much more. We actually expect the reset now in margins back to the upside, because the costs will catch up now with the lower prices, and therefore we believe that we will actually have better margins. On the demand front, we believe that Musk said we're hitting a law of large numbers, so this was definitely sobering. Does that mean we are maxing out on Y and 3? If so, well, how do you expect to keep growing the 20 million cars a year? Those are questions that I don't think I would interpret it. I mean, Musk is Musk. He sometimes just says things. I think there's still plenty of room to grow for the 3 and the Y, particularly the Highland 3. And then we have the lower cost model. Also, what are the expectations there? That's something we can talk to the IR about if we have time. My interpretation is that basically from this call is I don't want to worry too much now about the car business. The car business is in a reset because the macro environment is making it difficult for people to buy cars. Now, on the positive side, we have a very high oil and gas price, so that helps, of course, on the electric car front. We have generally also still high demand, plus we have the tax breaks. So the affordability of the car is definitely solved. $300-something lease per month for a Tesla. I would buy it for my son once he gets the driver's license. So this shouldn't be a problem. So to summarize, the earnings call is a reset. We have volume reset, a margin reset. However, we believe we are very close to trough margins. We will have earnings growth next year, even though we have lower volume growth, because we will have a better margin situation, and we also have the Cybertruck coming now. It's going to be a drag for 6 to maybe 9 months, but as Musk said, we expect, excuse me, this police in front. So I'm a bit confused what he's doing. So here's the thing. We expect the Cybertruck to start contributing probably about 12 to 18 months. Now, what that means is that we're going to have some drag on margins and cash flows because let's say you're selling Cybertruck at negative profit margins. This is a little bit like the Rivian situation now, right? Think about if you sell only 20,000 cars, you're going to have a massive amortization of fixed costs per car because you want to be, let's say you want to be selling 100,000 cars, but you only selling 20,000 cars. So the cost of 100,000 cars has to be amortized over only 20,000 cars, and that is very expensive. So this is one thing. We're going to have negative gross margin on the Cybertruck. That's going to hurt margins. However, we believe that we can offset that with lower costs for 3 and Y, and therefore hopefully troughing on the margin front. This is a hope. This is something that I guess we should discuss also with the investor relations person if we have time. But like I said, I'd like to not spend too much time on the car business because we want to think about 2 new earnings contributors. One is the AI front and the other is the energy front.